Guys, we are on site today right here in Myrtle Beach, South Carolina at 700 Mitchell Drive. That building just there, it is a 21-unit long-term rental property that's 90% occupied. In this video, I'm going to show you how this workforce housing is a stabilized income-producing asset from day one through a 6-year pro forma that I've created for you. I've also created the reversion information for you to understand how this property is going to sell. I've also created the financing information. I'm going to break down what financing on a property like this looks like in our market. I'm going to show you the unit mix. We're going to do a walkthrough of the properties so you can see the individual units. You can see where it's located right here off of North Kings Highway. And I'm even going to take you on a walk to the beach, which is super close, while we cover the financial model right down this road here. Guys, this property is already a winner from day one. It is almost fully occupied. The net sales proceeds on this property is phenomenal in year 5. I'm banking on you being able to make ridiculous cash over that 5-year hold with this property. Now, workforce housing in our market is in demand. It's in super demand, especially in this area in particular. This is one of those hidden gems. This is one of those diamonds in the rough. This is one of those properties where you walk up to it and you go, it doesn't tickle my fancy. It doesn't sweeten, it's not shiny, it's not sparkly. But the numbers don't lie. Guys, it's rented, it's making money. You don't got to look elsewhere. And with an easy adjustment of $150 increase in rent, plus filling the 2 vacant units, we're talking about increasing the value of this property by over $500,000 with just those simple 2 adjustments. Now, I know I'm talking a lot. I don't want to hold us up. Hit that like button, hit that subscribe button, and let's get into this video now. You'd like to invest in commercial real estate. I'd like to show you how these properties make profit and break down all their expenses so you understand how they operate, how they appreciate over time, and how this will impact your taxes. I'd also like to let you know the property's cap rate and how it compares with similar properties in the market, how the location best services its users, and the potential for future growth. I'd like to fill you in on the historical and future occupancy trends, as well as potential management structures affecting the investment. And we won't miss the investment's risk profile nor the best exit strategies. Yes, we'll cover the condition of the property, any value add potential and repositioning, but we'll also dive into special topics like customer base, market positioning, and marketing and booking strategies when it applies. And if you stay tuned until the end, I'll show you my top picks for the best commercial real estate deals that have generated the most annual profits, have the highest appreciation, and the best tax implications. So no matter if you're a first-time investor or a seasoned professional transitioning into the real estate game, or perhaps simply a casual investor looking to relocate to the beach to live, play, and invest so that the passive income can support you in your retirement years, whether you have 20% to pay down because you're financing or you're a cash buyer, if it's a commercial real estate investment that you're after, you'll be better because I'm aiming to give you a 10 times return on your time for watching my videos until the end. Now guys, we are on site today right here at 700 Mitchell Drive. That's what you're looking at straight ahead. There's a few buildings out here. I'm going to show it to you. That is North Kings Highway at this intersection here, which we will take a walk down to so you can see. That's one of the more busy intersections or busy roads in our market. You can see here we're at Mitchell Drive, 700 Mitchell Drive. And then to the right here, obviously you got a high rise here. But just looking straight down that road, that's the beach. That's sand and ocean right there. I don't know if you can really see the ocean from where we are because there's a little bit of curvature, but literally a short walk. We'll take that walk in just a little bit as we're going over numbers. I want to show you the property. So This whole piece is the property, literally. Now there is a pool on the property. It is not functioning, it is not working, but it is here, as you can see. This is a unit here. This unit here is two separate units, an A unit and a B unit. Downstairs, upstairs, parking right here. Now, this building, I want to say has 12 units. 2, 4, 6, 8, 10, 12. Yeah, you got 12 units in this building here. And then finally, this is just privacy fence. I got a rear entrance to this other unit here, this other building here. And then finally, we do have a separate unit over here, unit 702, which is its own unit. Now, guys, we're going to take a quick walk up to the front part of the building. There's just an intersection that way. This looks like a guest parking lot for the Oasis. That's the Oasis. Oh, excuse me, Holiday Towers. This is Holiday Towers here. This is Oasis, guest parking Oasis. Excuse me, that's Ocean 7. I thought it said Oasis. Ocean 7 parking lot. You've got some units across the street, as you can see, look like long-term rentals. This is our subject property here. So correction, there's more than 12 units here for sure, because we've got 2, 4, 6, 8 on this side. This is the front of the building. You see the wall units across the street. Got a golf cart store. And then you got stairs leading up to the second floor. So they've got some parking over here. I believe Myrtle Beach commercial real estate creates wealth differently than residential real estate because value is driven by income, operations, financing, and strategy, not just comparable sales. And in a market fueled by tourism, population growth, redevelopment, and migration, investors who understand how to improve operations and position assets correctly can create value far beyond what the average buyer sees on the surface. I believe Myrtle Beach's combination of tourism, retiree migration, and residential growth creates a unique commercial real estate environment where hospitality, retail, multifamily, and mixed-use opportunities can all benefit simultaneously. Most buyers focus on the property. Smart investors focus on the deal structure, the financing, and the upside potential. Before you move forward on any commercial property, let's walk through the underwriting together. Occupancy trends, cash flow, cap rates, expense ratios, reserves, financing options, and value add opportunities, so you understand exactly where the risk and opportunity exist. Call me now at 843-360-1737 and let's analyze your deal before you commit capital. All right, guys, we're just outside of Unit 106 right here at 700 Mitchell Drive. As you can see here, and plenty of natural light through that window. There's a wall unit here. There's seating area. You come right in. It's the bedroom area with some seating. Then you've got kitchen, refrigerator, stove, microwave, sink, full service kitchen. You got the backyard, which we'll get to in just a minute. He's got another little area over here he uses. He's got some storage area in this hall he uses for a closet. And then you have a tub shower combo, bathroom, vanity, mirror, light, you name it. It's here. And then we got the backyard. We do have storage, as you can see on both sides there. And the rear of the complex. All right, we're on site at Unit 702. It's a separate building from the main complex. As you can see here, there is another unit over here too. I just want to point out to you, which I'll show you in a minute. But let's get into 702. Outside, there is some land outside you can see with a storage. Living room as soon as you walk in. Let's start with the kitchen. Stove, microwave, sink, fridge. All right, vanity, tub shower combo here, as you can see. We've got a bedroom here. We've got an additional bedroom here. Closet. Wall unit. There's another restroom. Let's see if we can get a light on in here. There we go. As you can see here, another shower, another restroom. And that pretty much wraps it up. 2 beds, 2 baths. Just want you to see the backyard real quick. Wall units here for AC. Privacy fence, trees. There's the back of the structure. And then there's a little side entrance here, another wall unit here. And that pretty much, that's the outside. I believe understanding Myrtle Beach seasonality is critical because investors who know how to structure around peak season cash flow, off-season operations, and tourism demand patterns position themselves differently than those buying strictly on annual averages. I believe the strongest commercial investments in Myrtle Beach are often tied to population migration, healthcare expansion, retirement growth, tourism demand, and lifestyle-driven consumer spending. Myrtle Beach is transitioning from a purely tourism-driven market into a more diversified economic market, and commercial investors who recognize that shift early may position themselves for long-term upside. If you're considering buying a hotel, motel, or short-term rental hospitality asset in Myrtle Beach, understanding seasonality, average daily rate, occupancy, labor cost, and operational efficiencies is critical. The difference between an average hotel investment and a great one often comes down to management strategy, operational structure, financing, and knowing where value can be created after closing. Call me now at 843-360-1737 and let's break down the numbers and identify where the real upside exists. Guys, we're on site today right here at 700 Mitchell Drive in Myrtle Beach, South Carolina. Now, behind me is a 21-unit long-term rental property that is just shy of Business 17 and only a few minutes walk to the beach. And I'm going to take you on that walk now. While I'm taking you on that walk, so you see how close it is to the beach, I'm going to cover the financial model for this property. We're going to start with the property information. We're at 700 Mitchell Drive. That's what I got for the property name. Location, Myrtle Beach, South Carolina. Year built 1960. Heated square feet was 9,208. Total square feet 10,000. There are 3 buildings total. Technically, you can see there's a building here that's got an A unit and a B unit upstairs. There's the center building there, as you can see, and then just over in that corner there, you can see there is another unit. So 3 separate structures here. The lot location is east of Business 17. That's huge because east of Business 17 is where all the action happens in our market. Like if you're in Myrtle Beach, South Carolina, vacation rentals, being close to the beach, that's where all the action is. It's where all the tourism is. This essentially is really solid workforce housing in our market. And If you know anything about workforce housing, and I would imagine almost in any market, it is always in demand. This is a 90% rented, 90.5% rented occupancy rate on this building here. Now, rentals allowed. You can do both short-term and long-term rentals at this property due to its location. So if you wanted to do weekly rentals out of this property, and there is another property just up the road here, another 20 unit or so property, maybe 21 units, that I did a video on last year. They were running short-term rentals out of it. It's not uncommon in a vacation market to see a lot of short-term rentals. You can do weekly rentals, you can do monthly rentals. In our market, a short-term rental is anything less than 3 months. All right, now, just a quick caveat, if you do have a building like this and you do practice short-term rentals out of it, you might have difficulty selling it because it is much more difficult to get financing, for a buyer to get financing on a property like this with short-term rentals. In fact, I had a buyer interested in buying another commercial property here that was mostly short-term rentals ran out of that property, even though it was a long-term rental property technically, and he couldn't get financing on the property without taking some extreme measures that he didn't want to take. He had to put a lien against another one of his properties and such. So typically, what you see out of these long-term rentals, you can get financing on if it's long-term rentals. But if you're running short-term rentals out of it, it does complicate it definitely narrows your buyer pool when it comes to resale. Just a quick caveat here, just for all you sellers, maybe in your, if you're going to hold a property for 5 years or 10 years, maybe in that 8th or 9th year, you start transitioning. If you run it for short-term rentals, which can be very lucrative in some instances. There's another property here in our market over at 310th that did short-term rentals 1 year, and they brought their rental income up, a few $100,000. I'd say at least $150,000 by switching from long-term rentals to short-term rentals. So, is it great for income? It can be in the right location, sure, absolutely. Can you make more money that way? Yes. If you're going to be exiting that property, do you want to keep it short-term rentals? Probably not, because you're limiting your buyer pool significantly. I'd say in that, the year before you go to sell it, maybe 2 years, you start transitioning into long-term rentals. So it makes it easier for a buyer to get financing. Now, I know I've just went on a little rant there. Let's get into the unit mix and let's keep walking to the beach. Essentially, guys, you got efficiency studios, you got 16 units, about 400 square feet each. You're looking at an annual rent there of about $224,640. You have a few 2-bedroom units, 5 of those, about 560 square feet. We're looking at $90,600 in annual rental income. That's going to give you a total of 21 units, around 9,200 square feet, and for a total rental income capacity, a gross rental income to the tune of $315,240 if you have 100% occupancy rate. Moving right along, guys, let's get into the operations information. Now there is, got a guy on a motorcycle. Now there is no other income on this property. Sometimes at properties like this, you can have billboards or advertising, or you could be doing other activities out of the property, maybe allowing your parking lot to be used as a place to park, things like that, that can generate additional income. In this instance, you don't have that. Operating expenses, pest control, $550. These are actual totals from their 2025 statement, which I have the profit and loss statements. We'll probably flash those on the screen just a little bit so you can see. But pest control, $550. General maintenance labor, $35.70. Landscaping, $450. Cleaning and maintenance, $955. Legal, $832. Other professional fees, $2403. Electrical repairs, $1,255. Painting, $990. Plumbing, $3,959. HVAC, $7,530. Key lock or replacement, $720. Roof repair, $570. Repairs other, $3,100. Supplies, $4,209. Electricity, $951. Water, $136. Equipment, $101. Appliances, which are a capital expense, $1,834. Insurance, I've got you at $15,000. That's something I added in. I didn't see an insurance in the profit and loss statement. They got to have insurance on the property. Property management fee, I added that in as well. I think that they might be self-managing it. I don't know, but I'm assuming any property manager that's going to manage this property for you is probably going to charge you around 10% of the gross income. In that instance, that'd be $31,524. That brings you to an operating expense subtotal every year of about $80,639. And then you got to factor in property taxes as well. Your property taxes on this unit were $21,954 for last year. I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, because our market has been the fastest growing market out of the 150 most populated markets for the past 3 years. Over 90,600 people relocated to Myrtle Beach, South Carolina in 2023 alone. This means increased demand for commercial space like retail, multifamily, office, and industrial, and ultimately excellent annual profits and appreciation. Now, for retail, more residents equal more consumers equal higher rental sales potential. This drives up rents and occupancy in retail centers. For multifamily, higher population boosts demand for rental housing, pushing rents up and lowering vacancy. Now, for office, job growth typically follows population growth, increasing demand for office space. For industrial, more people means more consumption and e-commerce activity, increasing warehouse and last-mile logistics demand. Ultimately, the return on investment impact is higher rents, lower vacancy, and rising property values that drive higher net operating income and appreciation. I believe you should invest in commercial or real estate in Myrtle Beach, South Carolina, especially oceanfront hotels in the hospitality industry, because of the 20 to 22 million tourists that visit our market each year, which is the #2 vacation destination on the East Coast. High tourism equals steady demand, making it one of the most visited beach destinations in the United States. Our oceanfront hotels benefit from consistent seasonal occupancy, premium nightly rates compared to inland properties, and repeat visitors including families, snowbirds, and golfers. If you're a business owner thinking about purchasing commercial real estate for your company, the right property can reduce long-term occupancy costs, create equity, generate tax advantages, and strengthen your overall balance sheet. Before signing a lease or purchasing a property, let's compare your options and structure the deal around your long-term business goals. Call me now at 843-360-1737 and let's build a strategy that positions both your business and your real estate to grow together. All right, guys, now you can kind of see real quick before we get into the next spot. We took only a few steps up the road. You get into a little bit of retail shopping here. Just here, we got another really cool place people are living. And let me go back this way. Don't get dizzy on the camera. You got like a little mid-rise there. Now, investment information. Let's get into that. And before I keep going, just right there is the beach. Literally, you're that close. So I'm assuming you're going to hold for 5 years. The purchase price is right at $2 million, $1,999,000. Your commissions, I got you at $79,960 for your brokers to do the deal, $10,000 for legal for your attorney to close the deal and look over all your contracts and stuff. Due diligence, about $2,000 getting the property inspected. Total closing cost has you at $91,960. Now, working capital. This is debatable and optional. These are rule of thumbs, rules. You don't have to go with these numbers. I've seen some people use a whole lot less working capital. Working capital is what you keep on hand to float the business, you know, in case people don't pay their rent, in case there's vacancies, in case you got, turnover, which you are going to see some of that, People are going to let their lease expire or not pay their rent and get evicted, and those kinds of things happen. You have to factor in for that because it's going to cost you money while you still own and operate this place, even if they're paying their rent or not. So we've got and by the way, we are on Ocean Boulevard now. You can see here we've got sea dunes, oceanfront. We got Family Kingdom just there. Off in the distance there, you've got Ocean's One. We've got the Blue Hotel just here. So, it's pretty nice. Nice little spot. I want to say Yeah, just a little bit further down that way, we've got the Landmark and we've got Coral Beach Resort. Now, working capital. I'm going to take us all the way to the beach. Why not? I think it'd be fun. Just got to get across this road. All right, working capital. We got operating expenses, $22,500. You obviously need to have some cash on hand for operating that business. You got vacancy and turnover. I'm saying you need about $2,500 per unit, for 2 to 3 units vacancy at any given time, which is about right. Like people are going to move out. People, things will happen. Capital, I've got you at $25,000. You probably want to leave about $25,000 sitting in the bank, just in case. You don't know, HVACs break, appliances, all that kind of stuff. We've got a total working capital of $52,488. Now, your total cost of investment, including your closing cost and your working capital, comes up to $2,143,448. Your purchase price per unit is $95,190. Typically, it's anything under $100,000 is a deal that you should be checking out. Total cost per unit, we got you at $102.69, and then your going in cap rate is 8.89%. Let's keep moving. Guys, we got a little crowd over here screaming and shouting next to the beach. I don't know what it is, but they're having fun. All right, let's keep moving. Reversion information. Your exit cap rate, I've got you at 7.89%. What I'm saying essentially that, given all the new construction and all the people that's relocating to our market, I believe that our market's going to improve over the next 5 years. So much so that I believe you can, look at that cap rate drop by about 1%. Your gross sales price, if we can pull off that 1% drop in cap rate, would put you at $2,744,194. You're going to have to pay broker's fees to sell this property at 4%. That's a net sale proceeds after you pay those broker fees of $2,634,426. Excuse me, that's a net sale price. Net sale price of $2,634,426. Now, your net proceeds is after you pay off the loan balance on the property. I'm assuming, somebody might, a lot of our buyers, honestly, investors are going to be using financing to purchase this property, which I'm going to go over the financing information in just a minute. Guys, we're just at the beach access here. You can see right here, beach access. Literally, you're that close to the beach. You can see the buildings around here. I mean, this is nice, guys. This is nice. You do have like a motel here on the other side back behind me. You can see it there. All right, so let's keep rolling. But your net sale proceeds are simply going to be your net sale price after you pay brokerage fees minus your loan balance, which is $1,299,350. Now, how I arrived at the loan amount. Essentially, the bank's going to loan you about 65% of the value of this property. So ultimately, guys, 65%. You're going to have to pay 35% down to get into this deal. I'm assuming here that the interest rate's going to be about 6.5% and that you're going to do an interest-only loan. Now, you don't have to go that route. That's just what I'd built for this model. There are other models. If you want to buy this and hold it for 20 years, we can set up a different financing circumstance for you. Your loan fees are going to be 1%. I got your monthly payment at $7,038. Your annual debt service at $84,458. And again, that loan balance at $1,299,350. They're going to loan you 65% of that purchase price. Now let's cover your sources and uses of funds. Uses of funds, purchase price is $1,999. Closing cost, $91,960. Working capital, $52,488. Total cost of investment, $2,143,448. Loan fees, 1% of the loan that they're going to give you on the property comes out to about $19,990. So you are going to have to pay a loan fee for the lender to do your financing for sure. If you add together the total cost of investment plus your loan fees, you are left with $2,163,438. Now, sources of funds. Where are the funds coming from? Who's paying what? How's that happening? All right, so essentially on this deal, we only have senior debt. There's no junior debt. You're not taking multiple loans out. We just have the bank, the local bank here, or your local bank where you are, financing your deal to the tune of $1,299,350. Your total debt on the deal, $1,299,350. Preferred equity and common equity. Preferred equity, you don't have any of that in this deal. Common equity is your down payment that you're putting on the loan. That's that 35% down. That's going to come up to $864,088, and then your total cost of investment with the loan fees in the deal, again, there at the bottom, is going to be that $2,163,438. All right, so we're just about to get into your 6-year pro forma for you to kind of see how this property should function and operate. But before that, let's check out your growth rates so you know exactly how I arrived at the assumptions on these numbers. I'm assuming that you're going to grow your rent by 2.5% for the year. Other income is going to be zero because there's really not any in this deal. Your operating expenses are, they're going to grow by about 2% per year. Property tax is going to grow by about 1% per year. Salaries and wages, 1%. And then vacancy, it's currently sitting at a 9.5% vacancy rate. So it's 90.5% occupied with a 9.5% vacancy rate. 2 units aren't rented. That's it. Let's get into this pro forma. All right, guys, let's get into that pro forma. Now, your gross rental income, fully 100% rented, we're looking at $315,240. That's the gross rental income that's possible on this property as it currently sits. There is no other income. Your potential gross rental income, because there's no other income, is the same as $315,240. Your vacancy with that 9.5% of that $315,240 comes out to $29,948. Because 2 units are vacant, you're leaving almost 30 grand on the table every single year. So if you've got $315 in potential gross rental income, you take out what's vacant, you're left with effective gross rental income of $285,292. Now you've got operating expenses. Your property taxes were $21,954. Your other operating expenses were $80,639. That's what we went over earlier. Then I've got a reserve of $5,000. Probably going to put an extra $5,000 aside just in case. It's just a smart move. Total operating expenses brings you to $107,593. If you have $285,292 and you have operating expenses to the total of $107,593, you are left with a net operating income of $177,699. Now, your annual debt service was 84 grand. It's about $7,000 a month. If you have $177 in net operating income, $177,699, you pay your mortgage for the year of $84,458, you're left with an equity cash flow of $93,242. That's a 10.79% cash on cash return from day one. Most investors are targeting that 8 to 10% rate. You're already above the 10% rate in year one. And we haven't even, we have 2 vacant units. If you raise the rent by $150 per unit and fill the 2 vacant units, guys, we're talking about massive improvements in net operating income. We're talking about increasing the value of this property by $500,000 super fast, super easy. Anyways, all right, total cash flow and returns. Unleveraged. Unleveraged means we're buying this property cash. This is what it looks like over those years. Your cash flow in the first year, you're going to have to cough up the cost of the investment if you buy it all cash. $2,143,448. That's the total cost of investment cash out of your pocket. Now you have those cash flows from the net operating income dropping down every year, and you don't have any annual debt service. So you get to keep all that money because you don't have to pay a mortgage on it. Now, at the very end there, we're assuming you're going to sell it at that 7.89% cap rate. You're going to have that 6-year annual cash flow, but you're also going to add in the sales price. And I believe it was like 2.7 something. So if you factor that in, it's 2.85 at the end in that 6 year. Once you sell it, your internal rate of return there is 12%. That is if you buy this property with cash. Now, we're at the property, guys, right here. I'm going to take us to pretty much the busiest street in Myrtle Beach. Let's let this truck go by. And that is North Kings Highway right here. And so, like, positioning wise, I mean, like, it's phenomenal for workforce housing. Let's just be honest. All right, so leveraged. If I use financing to buy this deal, cash flow is $864.88. You got to pay that down payment of 35% in the first year. That's why it's negative in the first year. It's money coming out. Same thing for the unleveraged there. It's negative in that first year because you are paying money out. You are taking money out of your pocket. Then it's positive in those years following because you are receiving money from the investment, from the property. Now, 99,290, 105, 111, 118, 125. And then in that 6th year, you're going to sell the property. Well, you got to pay the loan balance off. You're selling it for 2.7, pay the loan balance off. You still got money left over. You're walking away with the 6-year cash flow and that net sale proceeds to the tune of $1,467,135. That's a 19% internal rate of return. Commercial real estate rewards investors who understand leverage, timing, operational value creation, and market positioning. Whether you're looking at multifamily, hospitality, retail, office, industrial, or development opportunities, my job is to help you identify where value can be created, not just where property is being sold. Call me now at 843-360-1737 and let's identify the opportunities that make sense for your investment goals and risk tolerance.